Hello and welcome again. I'm Chieh, the President of the Institute and Faculty of Actuaries, and it's my pleasure to welcome you to the fourth and final event of our Finance in a Public Interest seminar series. Firstly, I would like to acknowledge that this series has been generously sponsored by Hong Kong-based philanthropist IFOA Fellow Dr. Patrick Poon and Milliman Consulting. Thanks to their support, we are able to host this event free of charge. At the last count, there were 550 people registered for today's seminar. I would like to extend a warm welcome to you all. Throughout this series, I've provided the context behind the IFOA's Thought Leadership Program, so I shall not labor the same points today, except to say we aim to bring thought leadership to the foreground of the IFOA once more, and to reposition the IFOA as a center of key societal debates. While today bring our series of finance in a public interest to a close, may it also mark the beginning of an important conversation on how actuaries and the profession can and will participate in the sea change of an intellectual revolution in economic thinking, the changing narrative of how self-interest has to be balanced by collective interest in order to create a world to avoid the tragedy of the commons and the tragedy of the horizons. So far, we have 3 sessions. On Tuesday last week, John Chieh gave us an extensive exposition on radical uncertainty. He also talked about the ineffective and unsuccessful regulation in 2 industries, namely the pharmaceutical and the financial service industries, and referred to the regulatory disaster of moving from defined benefit to defined contributions in the pension sector in the UK. He expressed his abhorrence of the bonus culture in banking and questioned if we are attracting the right people to the finance industry. He lamented humankind's excessive need to quantify and to put a number where many things cannot be measured. He contended risk assessment is best done by firms themselves, but firms need to have the appropriate incentives and culture. On Wednesday, Sir Paul Collier offered a punchline, and the punchline was the way we, actuaries, do risk assessment has led to a riskier world over the long term. He was provocative in saying that our foolish actuarial profession has done much damage in the area of pensions, and that our risk assessment was completely disastrous. His criticism must be seen in the context of his overall criticism of the professions, including the economic, legal, academic, and accountancy professions. There has been an increase in specialization, skills, and technocratic ability, and a narrower focus on subject matter, coupled with a decline in ethical standards and holistic thinking in the last 50 years. In his thesis, overarching common purpose, shared narratives, and decentralization of innovation and experiments are critical elements. Only in that world can we inculcate a culture of mutuality and reciprocity. He argued that we are at an inflection point. There is an intellectual sea change from an emphasis on individualism to communitarianism, thanks to COVID-19, and this is supported by growing and compelling evidence in multiple fields, ranging from evolutionary psychology, economics, politics, and philosophy. He invited actuaries to be part of this dialogue and revolution and said that ideas do change society, and he sees great changes in the next 10 years. On Thursday, we had our own IFOA thought leaders. Ashok Gupta raised the issue that regulation and corporations today are not fit for purpose to serve societal and consumer long-term interests. Lucy Say emphasized on the importance of alternative long-term goals for sustainable outcomes and basically said aided GDP is inadequate as a measure. Nicole Espinal raised a more fundamental challenge to the current construction on how we define and measure the performance of capital and how the role of corporations must change and how actuaries can play a pivotal arbitral role in defining public purpose. Whilst not disagreeing with Paul Collier, Nick Silver gave an eloquent response to Paul Collier's comment on actuaries' responsibility on the state of pensions in the UK. In addition, he advocated a 4S model: equitable sharing of risk, sustainable investment, a resilient system, and stewardship of the assets we are entrusted. Today, we conclude this series with a panel discussion in an attempt to bring together the perspective of each of our speakers and to reach some tentative theoretical conclusions and about the practical next steps we can all take. The panel will consist of John Chieh, Paul Haldane Louise Pryor, and Andy Haldane. I will not make formal introductions of John Chieh and Paul Collier again, as I've done so last week. Suffice to say, they are well-known public intellectuals in the English-speaking world, famous authors, and highly respected economists. I re-listened to the recordings over the weekend, and I would like to thank them for helping us to start this important conversation. They have engaged, challenged, and encouraged us to speak to our public interest role and responsibility more proactively. Louise Pryor is my presidential team colleague. Louise, John, and Paul will join us after Andy Haldane has spoken. And Louise will bring her own perspectives to bear. She needs really little introduction for many of us. I would like to say that she has been a passionate and tireless advocate for sustainability, especially in the context of climate change, long before it has come to the foreground in recent years. In the course of a varied career as an actuary, software engineer, and academic, Louise was Director, Actuarial Standards at the FRC, where she led the developments of technical actuarial standards. Currently, Louise is the chair of the Climate Change Partnership and a non-executive director at the Ecology Building Society. Louise, welcome and thank you for joining us. But our main guest today is Andy Haldane, the chief economist at the Bank of England. He is well known for his unorthodox views and humorous style. His formal CV is on a slide, and shall leave you to read it. Instead, I would like to read what the UK Guardian newspaper said last October about Andy Haldane. Quote, "Central bankers and economists are not known for their humor, but Haldane's 2018 speech would have fitted in as easily at a stand-up club as among the neoclassical columns of the 324-year-old Bank of England, as well as the jokes Haldane told the audience that in the aftermath of the financial crisis, he learned more from speaking to charity workers and the people in the street than he did from all those economists and all those company bosses. It is not the first time," I continue from the Guardian newspaper, "that Haldane has stood out in the often rare field and academic world of central bankers. A speech he gave at a central bankers meeting in Jackson Hole, Wyoming in 2012 garnered worldwide headlines as much for its title as its message. The dog and the frisbee speech in Jackson Hole in 2012 was described as radical by Financial Times. And he argued that to ask today's regulators to save us from tomorrow's crisis using yesterday's toolbox is to ask a border collie to catch a frisbee by first applying Newton's laws of gravity." Unquote. Andy, we look forward to your humor and unorthodox thinking a bit later on. After Andy has spoken, I will briefly encourage conversation among the panelists for 30 to 40 minutes before taking questions from the floor. You can submit a question at any time via the online Q&A function on Zoom. And I would encourage you all to do so that it will give us some time to organize the questions more systematically. This session is also being recorded and will be available to view on our webinar afterwards. I will now hand over the floor to Andy Haldane on his perspective on the subject of finance in the public interest.
Well, thank you, Chieh, for that very kind introduction. Hope you can all hear me and see me. As if you can see me, you'll have spotted I've aged since that photograph that Chieh just kindly put up. It's great to be here speaking at the Institute and Faculty of Actuaries event, especially alongside and in such a distinguished company as Louise and John and Paul. Let me get my disclaimers out of the way first. As many of you will know, I'm not an actuary. That may have been obvious beforehand, but if it's not, it certainly will be by the time I finish speaking. I can only apologize for that. Secondly, I'm not speaking on behalf today of the Bank of England, certainly not for its regulatory or supervisory arm. So I think given those disclaimers, what I thought I might do this morning briefly is offer a few quick and general perspectives on the role of financial services and its regulation, which I think are relevant to your profession and indeed, I hope, also more widely. I think those views chime rather well with what you heard from Paul and from John last week. I look forward to discussing with them and Louise these issues a bit further. First, and most obviously really, financial services are of course meant to serve shareholders clearly, but equally importantly, customers, clients, policyholders, and indeed wider society. And in that sense, there should be no question really that finance is, or at least should be, in the public interest, to take the title of today's session. Yet we know, don't we, at various times in the past, parts of financial services have developed a culture not of servant, but rather of master. And while those cultures were perhaps more prevalent in banking than in asset management and insurance, I think no corner of finance has escaped unscathed from those crises and from those scandals, which have come thick and fast over a number of years. There have been a varying systemic impact and severity, but each and every one of them has left a societal scar and some degree of reputational damage. And it's really those failures taken alongside its public purpose that makes regulation of financial services necessary. Now, my second point is that while regulation might be necessary, it's fanciful to think that it could, or indeed ever should, be sufficient to tackle the problems finance periodically faces. If anything, I'd say, I think there's a risk of us sometimes having overloaded regulation and regulators in ways that could actually diminish incentives to manage risks within firms themselves, a kind of moral hazard, if you like. In other words, over-intrusive supervision or over-complex regulation can, without care, come at some risk management cost. I think this echoes points that John and Paul spoke about last week. Rightfully, the first line of defense against risk and rent seeking should sit squarely within firms themselves, as you all know. And while regulation has a crucial role to play as a second line of defense, ensuring appropriate management of risk and protection of policyholders, you simply cannot risk price culture nor regulate ethics. You can set behavioral standards, yes. You can seek transparency about whether those standards are being met, yes. But ultimately, the roots of culture and the roots of ethics are grown within organizations, from within the system, rather than being imposed from outside, or at least that needs to be true if those cultures and ethics are to be deeply embedded over the longer term. The deep cause of crises and scandals in finance has, at least to my reading, more often than not, been cultural and ethical, even if those crises and scandals show their face in excessive risk-taking or rent-seeking by organizations. Third point, on the appropriate form of financial regulation, and as Chieh mentioned at the beginning, I made myself just a tad unpopular in financial regulation circles a few years ago by suggesting the newly constructed banking standards may have been built on shaky intellectual and indeed practical foundations. That regulatory system, Basel III, I was discussing, but I think it's equally true of Solvency II and other flavors of prudential regulation. That's built around the principle not just of risk being capable of being priced, but of it being possible to understand system-wide risk by aggregating simple sum of a set of highly granular risk pieces, pretty much atom by atom. Now, building a model of system-wide risk from the bottom up, sometimes working at the atomic or indeed subatomic scale, probably works perfectly fine in sample at times when the world is stable. The problem, of course, comes that these risk models and the risk managers and regulators using them are particularly reliant, you might even argue singularly reliant, on these models most out of sample. In other words, when large or unusual events arise, and in situations where the world is not stable, but rather is unstable. And at that point, as we all now know to our cost, many standard risk models have been found to lack robustness in the control engineering sense, both individually, but especially systemically when you add together the atoms to get an organization-wide or indeed system-wide view of risk, which is critical, of course, at those times of crisis. In those situations, measurable risk ex ante can quickly morph into unmeasurable uncertainty ex post, to use that risk and uncertainty distinction that I know you heard lots about last week. At those points, correlations tend to 1, meaning that the idiosyncratic then naturally becomes systemic, and meeting regulatory standards then no longer guarantees robustness. And I think that John spoke about in detail last week. Put differently, in the language of complexity science, if the financial system is complex, which of course it plainly is, it's dangerous to fight that system's complexity with a system of complex regulation. That's for the same reason you tend not to fight fire with fire. You tend then to get an inferno, or in the case of finance, complexity squared, or at least complexity compounded. Fourth, when it comes to those large unexpected events, the ones I've just mentioned, one of the reasons our standard risk models appear to perform so poorly is because many are built on Gaussian foundations. That is to say, there are very few systems in the world, very, very few, whether that's natural systems or physical systems, or especially social systems with humans in them, that exhibit anything close to normal or bell curve like behavior. Most are heavily fat-tailed, meaning the extraordinary is significantly more likely than our standard risk models would imply. Having said at the beginning, I'm not an actuary, which I'm plainly not. I did once publish an article actually in an actuarial journal called Tales of the Unexpected. That's TAILS, which is basically demonstrating empirically these fat tail systems points, looking at every system under the sun, including, of course, financial systems. The global pandemic of the past year is plainly another drawing from that fat tail distribution, one missed by, I think, virtually every risk model out there. And in fact, the measurement challenge is actually even more difficult than I've made out, because it's not just that every complex system under the sun is heavily fat-tailed, it's that this fat-tailed property is becoming, if anything, more prevalent and more severe over time. Fat tails or extreme events are endogenous to the system, not exogenous to it. And now, why is that? Well, we know from our complexity science that the more complex, and in particular the more interconnected the web, that could be a financial network, it could be a migration network, it could be a trade network, it could be a social network, the greater its connectivity and complexity, the greater is its degree of fragility. The more likely it is to tipping points, the more likely it is that the idiosyncratic will become systemic. The more likely it is that measurable risk will morph into unmeasurable uncertainty. And that robust yet fragile property of connected webs is, for me, one of the defining features of systemic risk: economic, financial, health, social, indeed one of the defining features of our era. It is why the global financial crisis 12 years ago was the world's first ever genuinely global financial crisis. And it's also, of course, why the coronavirus pandemic was able to bring all of the world to its knees in the matter of just a few weeks. And that rising tide of radical uncertainty is a feature typically not well catered for by many, if any, of our risk models. Fifth and final point, given those uncertainties, what risk management responses do we have which offer the best chances of proving robust and resilient to that not knowing? Well, I think Paul discussed last week, the use of experienced judgment alongside risk models is, I think, an essential blend here, whether it's risk managers and individual firms or risk regulators safeguarding the system as a whole. As we've known about for a long time, has been found in many other domains, it's that mix of human and machine intelligence that I think can offer some degree of insurance against the combined perils of risk and uncertainty. That's even true in systems much less complex and much less adaptive than finance. Let's take a simple one, playing chess. The best chess player in the world is not, in fact, a machine, despite the fact that Deep Blue beat Garry Kasparov more than 25 years ago. It is, in fact, a human aided by a machine. And that's been found to be the case in many other more complex and uncertain domains. And the greater the degree of complexity and the degree of radical uncertainty in the system, the greater degree of reliance, I think, that should be placed on expert judgment alongside AI, a sort of co-evolutionary path, if you like. And it's that thinking that lies behind the Bank of England's own regulatory approach, which is founded on a judgment-based approach to supervision and regulation. So regulatory rules are one of the tools, but do not by themselves dictate the decisions. Now, there's no question, and I'll close on this, that these tools, whether they're human or machine, can, of course, be improved over time and should, of course, be improved over time. Both AI and human decisions are now well known to suffer their own biases. Algorithmic biases, born of being trained on historical data for machines, and behavioral biases, born often of deep evolutionary experience for humans. But I think that by combining the two, that would tend to damp rather than amplify those biases, provided humans and machines are allocated their tasks appropriately on that risk versus uncertainty principle. There's doubtless, Suee, a lot more that could be said here, but I think at that point, let me stop and look forward to discussing these issues with Paul and John and Louise and with you all. Thank you.
Andy, thanks for such an excellent sweep. I don't think there's anything you say which are inconsistent with what had been said. Although you did introduce some new elements on complexity thinking more specifically, and the role of partnership between human beings and a machine in assessment of complex systems. Yeah, and there are multiple levels of analysis from personal interest, society's culture, and the march of the Washington Consensus, to radical uncertainty, to role of corporation regulators, to role of professions. Yeah, many levels to tackle. And we got some very interesting questions appearing. But let us stay in this space. I would like to invite firstly Louise, and then later maybe John, and then Paul. Reflections on what Andy said, and on the last week, highlights and perspectives. Louise, do you mind if you kick off the discussion, Louise?
Thank you, Chieh, and thank you, Andy, for a very some very perceptive analysis of some of the trends we're seeing and some of the phenomena that have arisen in our very complex financial world. I think there's two things I'd particularly like to pick up on. One of them, which completely speaks to my own experience in computer science and artificial intelligence and all that sort of thing, is the place of modeling. We, I think, have become over-reliant on models. To think of it as a combined system, that you've got the expert and the model, and it's the combination that produces valuable input is of course right. We have to think there in terms of both the experts who build the model, the assumptions that go into it, but also the experts who interpret the results, and there's judgment at all stages of that. The difficulty I find comes in practice, where people outside that team tend to place much more reliance in the computer part of it than anyone connected with the computer part of it does. So it's always, but the computer says so and so. And as an ex-software engineer myself, I'm always very skeptical, because I'm so aware of the problems of implicit bias through all the assumptions and everything, but also the things have bugs in. There are just mistakes in implementations. Just placing an over-reliance on the detailed results of models is very, very dangerous. And of course, we do see that in our current regulation, where we are being asked to model things right out in the tails at 0.5% probability, which, to be honest, I don't think we have any real idea how to do consistently. The other point I wanted to pick up on was actually your first point, when you said financial services are meant to serve customers and the wider society, but sometimes they become the master rather than the servant, and that's very, very true. One of the things we are not seeing now in a rapidly changing world, when we're starting to think of all sorts of different issues, especially such as sustainability, and especially with all the growth in technology and things, is we're not seeing a huge proliferation of new types of financial services products that are designed to address the needs of either society as a whole, but in some ways, almost more importantly, the actual consumers, the actual end users. Very little innovation going on, which is in some ways surprising, because there are a lot of smart people out there. but in other ways, possibly not surprising, because the incentives aren't there. The incentives seem to be for doing what everybody else is doing, but slightly better or slightly more money making, than actually going back to basics and thinking about, are there different risks, for example, that we should be working out how to insure? How can our insurance policies, how does the structure of insurance policies, does that support and incentivize adaptation and mitigation to risks caused by sustainability failures? The answer appears to be no. You talk to people, I talk to people in the industry, they say, oh, but that's the market. We can't go against the market. So we do need to think, I think, about how we can encourage more innovation to do things in different ways that better serve both society's needs and, as part of that, individuals' needs. Thank you.
Thanks, Louise. Before I pass to Paul and then John, maybe I can do a bit of framing, because we got quite a number of levels, and then pass it number of levels. Yeah, because there is a discussion on models and radical uncertainty, yeah, and the inability to capture. Then there's a discussion on culture, and Andy, you implied that should be within corporation. That's an interesting observation, because corporation exists in a framework of a society. Yeah. And Louise talked about products, which is a manifestation of the space we need to thrive on, and if the space conducive in creating products which serve public interest. Yeah, and I chose to start with Paul. Paul, in your speech and in your books, you talk very much about culture and purpose and narrative, which is the meta story of our society. The meta story of society. And the Washington Consensus and private interest is a 40-year journey in the context of certainly Anglo-Saxon history, but have come unstuck, right? And we are still, our regulation is still based on Basel III and Solvency II, yeah, which is still financial economics. So we are in a tangle. So I would like to ask Paul maybe to help us unpack this, right? There's part on culture, the part on economic history and the changing, then part of regulation in which Bank of England and the pensions regulators sit, and then there's a profession and individuals like us. How do we start unpacking this? Maybe Paul, and then we go to John, yeah?
Thanks very much. So let me start with the notion that people's behavior is driven overwhelmingly by the norms of the organization they're in, the culture, and by the habits, the daily habits that they get into. So most behavior is actually habit driven, and the habits basically express the micro of the culture of the organization. And the culture of an organization is set from the top. The chief executives and the senior team basically control the narratives that guide the culture of the organization. And so a good chief executive builds a culture which generates good habits and so good daily decisions. A bad chief executive does the opposite. They build a culture, a set of habits where the daily behavior is destructive. So let's go back to this. What are the incentives for the chief executives and senior executives to build a good culture or a bad culture? They are the communicators in chief in an organization. That's the power that really, really matters. They set the culture. And so I want to go back to Andy's point about the double layer of complexity, the interaction between a complex real world out there that a chief executive somehow got to get their mind around using this combination of the AI technology and their own judgment and wisdom, and the complexity of regulation. And and I want to look at that regulation through the eyes of two key professions, the lawyers and the actuaries. And how does the chief executives draw on lawyers and actuaries in guiding them towards their judgment? And let's look at it. So how do chief executives and senior people in the financial system use lawyers? Well, I know that very well, right? They hire lawyers from Magic Circle banks. They pay them £700 an hour, right? $1,000 an hour, right? What are they paying them for? The lawyer's job is to produce micro defenses for the behaviors that the chief executives and the senior executives have got, so that if the ship blows up, they will have a micro defense of every action they did, which exonerates them. So they can never be prosecuted. They can never be held responsible because they have a legal opinion from a lawyer, and they have an actuarial opinion from an actuary that gives micro justification for that micro decision. That process of exoneration is why no senior executive in the banking system was successfully prosecuted, right? But that process of exoneration is exactly what you don't want, because it absolves the senior people from the need to use their judgment. And that is the catastrophe, because then the micro behavior of the organization is driven to this maximization of profit rather than to building a culture which actually produces wise judgment. Right? So I'll end with just one little example. I'm working with a social enterprise in Doncaster, which has 19, all 19 are bank managers in the locality who were made redundant. And now they're working in a social enterprise to try and get finance for small firms. Why were they all made redundant? Because all the clearing banks moved from a model in which the bank managers were there to combine the evidence of their models with their own judgment, their own eyes. The banks shifted to an entirely model-based tick box assessment of risk. And if you do that, you don't need bank managers, but also the only way you can contain risks if you don't know anything about judgment is to say no. And so the finance for small enterprise outside London has collapsed. That's the consequence of this retreat from judgment to micro defense of a micro decision. Thank you.
Thanks, Paul. I'm having an eye on the time. Before I pass to John, because I think at about 9:15, I really like to tackle the Q&A because there are quite a long series of Q&A coming up. But I wanted to maybe ask Paul to comment later on. You mentioned about CEOs setting the tone at the top in the organization, and obviously I agree with that. But there's a broader societal narrative or the industry narrative, which Ashok Gupta, one of our senior actuaries, pointed to. He said that the transparency of CEO pay actually lead to leapfrogging of CEO pay in the banking sector. I think there's some truth in it. The tone at a societal level, and if I may say so, in many of the Anglo-Saxon society has gone slightly out of kilter in the last 20 years. Yeah. So should the tone be spoken in terms of the national narrative more compellingly, and our leaders in the wider society probably have to take a lead? I'll leave you to comment on that when you have a chance. But because I want to give to John K. and then maybe Andy for some final reflections on this before we open to the floor. John?
Yeah, I'll pick up 2 points there. One is with what you've just been saying and what Paul ended with before, and this is a matter of societal narrative and organizational culture. Some of you on this call may know of a case currently going through the US courts of Goldman Sachs versus a class action led by Arkansas Teachers Retirement Fund. And the base of the case, it's about Goldman Sachs' statement of ethics, which says our clients' interests always come first. And the claim which Arkansas teachers are leading says that we Arkansas teachers were misled into investing in this company by its statement of ethics. Now, the Goldman Sachs defense to that charge is not that our statement is true. On the contrary, it is that it's so obviously untrue that nobody could reasonably have made an investment on the basis of believing it. And they have, the Goldman Sachs defense has produced 30 examples of conflicts of interest being disclosed in the newspapers without it having any effect on Goldman Sachs' share price. Now, you stand back for a moment and ask, how did we get into a world in which this was even possible? And one might say, well, the financial services industry is actually pretty bad, and Goldman Sachs is pretty bad even by the standards of the financial services industry. But the US Chamber of Commerce has filed a friend of the court document in support of Goldman Sachs that says all companies make statements of the kind, our customers always come first. Integrity is at the heart of what we do. They go on to say, if the court were to find against Goldman Sachs, companies would in future make these kind of statements at their peril, I quote. Well, there's another way of dealing with it. They might either refrain from making these statements, or if they do make them, take some steps to ensure that they're true. The point is that we have, over the last 50 years, one might date it, as it were, from the notorious Friedman, 1970, the duty of social responsibility of a company is to maximize its profits. We've created an environment in which it was not just possible, but even suddenly acceptable, even required to say these kind of things. And unless we can change that societal culture, we will not bring about the kind of different case changes we need. Second point I'd like to pick up from what several people on this call have already talked about, which is the ways in which we use models. And for me, the key point is that economics and the areas we're talking about, risk, uncertainty, and the like, models, in my view, are indispensable, but models are parables. Stories like the classic models of economics, or Ricardo's comparative advantage back in the early 19th century, to modern models. I often talk about George Akerlof's model, Lemon's model of asymmetric information, which is rather fundamental to understanding financial services. And Akerlof told that story as one about the used car industry. I remember explaining that at an event once, and someone got up and said, I'm the General Secretary of the Retail Motor Federation, which represents used car dealers in the United Kingdom. And this story is a monstrous reflection on the integrity of our hardworking members. Well, of course, he'd missed the point in several senses. One is, I doubt what we were saying was true, but also, this is not a story about the motor car industry. It is a way of thinking about markets with imperfect information. And once you've taken that model on board, you think about these kind of markets differently thereafter. That's, for me, what economic models are about. They're parables, they're illustrations, they're ways of organizing your thinking. Now, that's been displaced in large part by the idea that models are about spreadsheets that contain all the information you might conceivably want to make a decision. And then you discover you don't know that information, So you make it all up and you fill in all the spreads in your spreadsheet. And then you realize you can't quite be sure you've got these numbers right. So you make up a different set of numbers and put them in the cells of the spreadsheet. And you then do that 1,000 times. And people actually believe that if you then run the computer 1,000 times, you've generated some probability distribution of the outcome. And you do not generate a probability distribution by making up a number you don't know many different times. When I put it like that, it sounds extraordinary that anyone should believe that you could, but they do believe that you could. And this is done again and again in all the professions we're talking about. So we need to think about models in a different way. Models are not telling us the truth. Models are enabling us to organize our thought, to test out possible scenarios, and to understand better how the world is working, and most of all, what the important parameters are in the world that we should go out and try and find more about. They are not ways of forecasting a radically uncertain future.
Very good, John. So using your language, I'm going to take a step back and then give Andy the last, the final comment before we go to the Q&A. Because what you have said is actually about two very important points in your reply, which points to a fairly embedded systemic problem, which can only be influenced through change step by step, inch by inch, as Paul Collier said, through conversation, persuasion, challenge, and ideas. Yeah, one of your first point, it was about culture, about societal culture, which emanate from the Friedman Revolution, and that revolution was in response to the problems of collective interest or centralization of that time, of big government. But the narrative has changed because this problem may not be so evident in other societies of excessive interest in other society. So there is a 50-year story about that. Your second story about lawyers and actuaries, which is Paul Collier's story, but was actually about the specialization and the atomization of our skill sets. We get narrower and narrower, and we stop seeing the big picture. And I think you sort of alluded to it, that it actually began 300-400 years when we started to unpack probability and trying to capture the way in terms of numbers. Yeah, but clearly that is not good enough in a much more complex world. So we may have to take a much bigger step back to think about such analysis. Yeah. But then you zoom forward. We are here where we are, where our profession is still working. People have to turn up for work next Monday. What do we do next? Right? I'm going to offer the chance for Andy to reply to this conversation and then reply to the questions which our members are asking. So what do we do next on Monday? Yeah, which are quite interesting. Yeah, Andy.
Suee, thank you. I'll be very brief because I know you want to go to the audience for some questions. I think we all want to go to the audience for some questions as well. But two very brief reflections on what I've heard from Louise and from Paul and from John. I mean, I agree with it all. I mean, two key themes came out for me, and one was the one you touched upon there, Suee, which is how important not just individual but societal cultures might be in framing what goes on here. I'm always struck by things like, if you look at surveys of the attitudes of CEOs towards how they run their organizations, it's not as if the law, the kind of corporate governance law in, say, Japan and Germany, is that radically different than the legal infrastructure in the UK or the US. But when you ask the chief executives of those organizations, who are you serving? They give radically different answers. You know, executives and shareholders on the one hand, broader society, customers and staff on the other. And I think that, as I say, is not a reflection of the legal fine print. That is a reflection of something broader, something organizational, something societal. And perhaps, I hope Paul and John are right, perhaps we're at a point where there's scope for converging on that rather more communitaire model. The second theme I thought was really interesting from everything that Louise and John and Paul said was the prevalence of defensive decision making. That is to say, decision making that has too much of an eye to self-preservation or not being tripped up on having done the due diligence or followed due process, and insufficient on organizational or societal success. I should say, and I know everyone on this call knows this of course is not a problem distinctive or unique to financial services or actuaries or bankers. This is prevalent across certainly all of the professions, and indeed I imagine much more widely. I remember looking at some of the evidence on defensive decision making, for example, in medicine, where the threat, certainly in some economies, is very real of litigation, and that naturally enough generates a natural tendency to overprescribe drugs and to overadmit people to hospital, which actually is often not in the best interests of the patient from a risk perspective, but does cover the backside of the person prescribing. So I think finding a better balance point or a means of leaning against that defensive decision making is a crucial ingredient. Let me stop there, Suee.
Thanks very much, Andy. I think your keyword there is balance, right? Balance, because there's no perfect society and there's no perfect culture, right? But we have gone out kilter. And it's interesting that you mentioned Germany and Japan, but the number of lawyers per 100,000 of people there is probably a fraction, maybe 10% of what US and UK. And you should refer to the excellent book written by our friend Paul Collier on the future of capitalism about how lawyers are not, I got many lawyers who are listening in, are not really adding real, there's a question about how much value they're adding to the system as in financial services. I think there's a real point of, and in Japan, there's hardly any lawyers. There are hardly any lawyers in many of the deals. Okay, but they have issues of their own. Yeah? So with that, I would like to go to our users, our members. Michael Clark asked this question last week, and we wanted Andy Haldane to be here before we put up this question because it's about Her Majesty Treasury. The one is on Green Book, and the question reads this way: does Her Majesty Treasury Green Book in any way inhibit transformational change? Example, managing climate risk. If so, how might actuaries influence the thinking which frames the Green Book approach? I think it's something for Andy and possibly Louise and Paul, John, if you want to comment.
Yeah, well, I'll be a little bit and probably understandably cautious in criticizing too much my my colleagues at Treasury in the UK. I mean, the UK Green Book which is the means by which government spending choices are evaluated in a cost-benefit sense. I think it's fair to say that is currently on the move, that the thinking underlying that is evolving, I think evolving in the right direction. I think with the benefit of glorious hindsight, the focus of that Green Book cost-benefit evaluation historically has probably suffered from two problems, one of which is its relatively short-term focus, which you might call in the language you used at the beginning, Suee, the tragedy of the horizons, with too much discounting of often quite distant returns, which I'm not sure from a societal perspective makes very much sense. And the second dimension in which it could have been said historically to have been partial is by not embracing a sufficiently expansive view of societal returns, as distinct from kind of financial returns, tax receipts and the like. And that, if you like, is the mirror image of the other tragedy you mentioned, which would be the tragedy of the horizons or the underinvestment in, it could be environment, it could be natural capital, it could be social capital, it could be human capital. And I think both of those are historical gaps, and I'm hoping ones that future vintages of the Green Book can look to fill, because they speak exactly to the issues we've been wrestling with today. I think I'll stop there, Suee. Thanks.
Thanks. Louise, do you want to respond to that?
Yeah, I mean, I think this is an important point. I know that there is some rethinking going on the Green Book at the moment, especially about the long-term interest rates for connected with sustainability issues. What I'm slightly concerned isn't really coming to the fore is what does it mean to think about cost benefit analysis, if you like, even if you're looking at the wider societal aspects. When you've got processes, when you've got impacts that might be completely irreversible and that might radically change how society as a whole, but also the economy operates in the future. So are the models you're using, I mean, discounting is an incredibly simple conceptual model, obviously. Is that still valid in those circumstances when you might have, if you like, a discontinuity in the future? And the answer is clearly no, but what do we put in its place? And I don't have a good answer to that. And it's something around which we need to do a lot of serious thinking.
I would go back to the issue I raised earlier about you do not model by inventing numbers to fill in all the cells of a spreadsheet. And my bête noire of the last decade, actually, in this field of modeling has been something called WebTag, which is actually the Transport Department's application of the Green Book. And that is a spreadsheet which fills in an amazing range of numbers you didn't know. If you want to know how many passengers there will be in a car in 2036 on a Friday afternoon, there's a number in WebTag which will tell you. If you want to know what the British growth rate will be in 2080, you can find the number in WebTag to one place of decimals, and so on. And all this is nonsense of the most absurd kind, which is not to say that the approach which is underlying this, which is a systematization of the costs and benefits of projects, isn't a good way of organizing decision-making or a good input into decision-making. It's a necessary input into decision-making, but it's not well conducted by lots of invented numbers. And the key way of approaching it ought to be to say, what are the 3 or 4 key parameters that are relevant to an appraisal of this particular project? And that's the way we should be doing it. And as both of you have pointed out, Andy and Louise, there is sensible rethinking currently going on in the application of the Green Book in this kind of area. And I think we should all encourage that.
So,
John, one of the numbers that wasn't in WebTag was when there's a vote on Brexit, how many people in the north of England will vote for Brexit? Because here was one of the things that the Green Book led to was a vast overemphasis on the returns to investment in the southeast relative to investment in the rest of the country. And so you've got a massive skew of public investment towards the southeast because on their numbers, the returns were highest. That then produced social risks which have exploded into something of existential importance for the country, which is the Brexit vote. But that wasn't in the WebTag. Right? Let me give you one other example, which is our university training. So we've had a massive expansion in university training, but it's very skewed towards the social subjects, and for example, away from medicine. Last year was the first year in which we trained less than half of the doctors the NHS needs to function. So where did we get the more than 50% of the doctors that we're not training in all of Britain's universities? Well, we got them from universities in Sudan, in Sierra Leone, in Ghana, in Nigeria. Ghana has to train more than twice as many doctors as it needs because more than half of them move to Europe, mainly to Britain. Why is that done? Because it's cheap in the short term. Of course, in the long run, it's both an ethical disgrace and very dysfunctional for the functioning of our health system. So these are drastically foolish decisions that were justified on Green Book calculations.
Okay, I heartily agreeing with you, and the richness of the conversation is engaging, but I want to make sure that we have as many questions as possible. So I'm going to be more specific. But John, what you said really point towards a different way of thinking, not analytical thinking, but phronesis, practical wisdom, and multidisciplinary approach, which is necessary in a complex world. And the atomization of our professions is not helpful in this regard. And that is, you have spoken about this widely, and that is also very consistent with our new strategy in IFOA, that our approach should not just be analytical alone, but require a multidisciplinary approach. But I have a question very specifically aimed for Paul Collier on your criticism of an actuarial review, and I think you did name Legal and General that did not mention pandemic risk. At the same time, you criticize pension scheme solvency calculations as he could not see any scenario under which university could fail to continue to fund them. Surely this is cherry picking. Which uncertainty to consider in setting assumptions? Would you like to respond to that in a brief way?
Well, I'm sorry, but these are two very, very important examples. They're emblematic of something that, as John said, is much larger. But the Legal and General, for example, would like to invest in smaller British companies. Catherine Latour, who's the head of the British Business Bank, has set up a portfolio of companies, British businesses, smaller British businesses. And she says, well, the European fund managers are queuing up in Europe and America because they have a sense that investing in smaller British companies would be a very good long-term investment strategy. So she says, I've no problem. If I open this fund up, I'll get loads of European and American investors, but I can't get British investors. I can't get British fund managers in. And Legal and General are complaining that the reason they daren't invest is the criticism they get, the micro-analysis of what is a safe portfolio. So there's this syndrome between regulators and the professions, which is trapping the big British fund managers into not investing in things where the culture being different, continental European fund managers and American fund managers both want to invest in British companies. And so it's ludicrous. So this is existentially important. I'll leave the USS thing to John.
Okay. I wouldn't want to dwell too much on the pensions one because I want to move on because we're in the last 30 minutes. There is a question on stewardship from Martin White, who has been a passionate advocate for the small shareholders, as well as Sally Bridgeland, who is also a senior steward in her own right. And I would like to maybe ask John Kay and Andy to comment on this, right? Martin White referred to Collier's key theme that business needs to be morally purposed, and also refer to your book on ubiquity about success in business should be a consequence of treating all stakeholders well instead of just maximizing profits. And his question is that this suggests that company managers, stewardship, leadership, service need to be watchwords rather than personal success and status and greed. The question from Martin is how can we move in this direction when the financial sector operates an ad valorem model that makes it very profitable and well paid? And then the question from Sally Bridgeland, who is a very experienced non-executive director, wants comments from Andy Haldane about the role of regulation and regulators what lessons can we draw for the role of non-executive board members in managing risk, and how can machines and AI help them? So John and then Andy.
Right. There are several large points there. The first is, how do we, well, we've kept coming back in the course of this discussion to talking about the need to change the culture and the language in which people talk about business. And that for me is absolutely key. I remember once I took a retired chief executive of a very large British company to come and talk to my class at London Business School. And at the end of it, he said to me, you know, these kids regard being chief executive as a prize rather than a responsibility. And we were talking earlier about the 50-year trajectory of, as it were, Friedman on. And that encapsulated really the change which has occurred. I think the one positive thing one can say is that if you can change it in one direction, you can change it back. And what we need to do is to promote a dialogue in society that does change it back. Second very good point that Martin made, I think, was that the financial services sector is basically very largely rewarded at the moment on the basis of transactions. And that encourages a great deal of activity and innovation, which has little, if any, positive value added to the community. And I think the answer to that has to be, in the end, pressure from investors. That is, we are not well served by this constant churn of securities. And I've written many times elsewhere that the extraordinary thing about the modern financial services industry is, if you ask what do these people working in the City of London and Canary Wharf mostly do, the answer is they spend the day trading with each other. And if you stand back from that and ask, what is this doing? You start to have serious reservations about the extent to which we've benefited from the growth of this sector. But I think ultimately the responsibility for rectifying that is going to lie with savers and investors.
John, your book of 2 or 3 years ago on whose money is it anyway, or something to that effect, captures this. Someone else's money, yeah. It was capture all these issues, which I think is still with us. Now we go to another question, which is what do we do on Monday morning question. I want to combine with Phil H question with John Taylor's question, which is really about models again, right? Phil question is that the limitations of trying to estimate and quantify extreme events in complex and ambiguous systems have been well articulated. How instead do we build cultures in companies which embrace that we just don't know out of moral risk, which are important one, and that we need to make decisions in this context nevertheless? John Taylor question is, the map is not the territory, but it's seductive to believe we know the territory as well as we know the map. In a world that places so much reliance on quantitative methods, example, solvency coverage ratios based on correlation matrices, how can boards, regulators, etc. allow robustly for radical uncertainty? So we are circling back to the same issues, but in different language. Yeah, I do not know whether Andy, you want to lead, and who else want to have a go on this one?
I'm happy to say a word briefly, Suee. I mean, the question well, flows very naturally, I think, from all of what we've said today about the potential fragility of anything that claims precision when it comes to the measurement of risk. What might be done given that? Well, I do think the direction of travel we've been on for the last 10 years, which is greater use of stress testing, can help. I think the greater use of scenario type analysis, if you like, the other kind of quantitative counterpart, of John's parables from earlier. I think they can help. I think the conversation about those scenarios and stresses is every bit as important as the numbers that may be thrown out by whatever models you are using of them. I think, to go to your cross-disciplinary point, Suee, looking to use a plurality of approaches drawn from different disciplines, I think that can be part of the insurance device against misspecification too. Ultimately though, the lesson from other complex systems is the need to build in a healthy degree of redundancy in that system for not knowing, to run with, on average, somewhat larger degrees of protection that a simple reading of any model would suggest. And that cushion is in as a safeguard against uncertainty, as distinct from risk. The other thing I think that goes a bit in that direction is seeking frameworks that are themselves not overly complex and have a degree of simplicity embodied within them. I think some additional degree of robustness comes from simplicity as well as redundancy. So those would be a few directions of travel there. Thanks.
Can I pick up on that and say that what do engineers in complex systems do to make these systems robust? Well, there are two key elements to that. One is modularity, which is you ensure that the system is designed in such a way that if bits of the system fail, that doesn't lead to a failure of the whole. And the second is you institute redundancy so that components are all stronger than the minimum they need to be, or the minimum that you think they need to be in order to fulfill their function. Now, if one looks at the financial services sector in recent decades in that respect, we've regarded redundancy as a measure of inefficiency. You heard banks talking about surplus capital, which should be returned to shareholders, as if a bank could have too much money. And you had the removal of the silos in the financial services, which separated insurance from banking, proprietary trading from retail banking, and the like. And all these silos were broken down. So we created massively more interdependencies and removed modularity with results that we all know. So robustness and resilience are achieved by modularity and redundancy. And we need to relearn that lesson. Second is the map is not the territory. It's worth thinking a bit about what the Polish philosopher, whose name I'm afraid I can't pronounce, who coined the phrase, meant by it. And really there were two things being involved there. One, saying the map is not the territory, is to say, and this goes back to what we were talking about in terms of models. The map is, as it were, a deliberate simplification, which is purpose specific. We're all familiar with the London Tube map, which is actually an inspired piece of graphic design. It's very helpful if you want to find your way around the tube. It's very unhelpful if you want to find your way walking or driving around London, because the stylization which is needed to achieve it for its purpose of the tube makes it inappropriate for that. And so models is a good example of the philosophy of models we've been describing, which is models are parables, they are purpose specific, and you need a different model of the same thing if you're answering a different kind of question. The other thing about the lesson of the map is not the territory phrase is that making the map more and more realistic does not help. There's the Borges story about the competition to design the most accurate map of the world. And of course, the most accurate map of the world precisely replicates the world and is therefore entirely useless for any practical purpose. The map is not the territory is a phrase well worth, as it were, chalking on the wall of anyone in the kind of business we're in.
I come in to pick up on the what do we do on Monday morning question?
Yes, please.
We have to, and I think this is possibly a bigger problem for actuaries than many other people. We have to stop thinking that quantification is the answer, putting numbers on things. We have to learn to think, I think, more qualitatively about some things. And certainly from the uncertainty point of view, it's probably useful to think about how manageable would this outcome be and how avoidable would this outcome be. If it's avoidable but unmanageable, you try and avoid it. If it's manageable but unavoidable, you try and manage it. You don't waste time trying to avoid the unavoidable or manage the unmanageable. And obviously most things are somewhere between the two, and you have to think about where along that line you want to go. The useful thing is that quite often some of the same actions will serve both purposes and possibly have other side benefits too. But I do think that this qualitative way of thinking about uncertainty is more useful than trying to put spuriously accurate or spuriously precise quantitative estimates on it.
Just build on the Monday morning problem very quickly. And that, I think, a very good test for you to do on Monday morning is to say, is this action of mine basically about shifting risks or reducing risks? And the demise of the defined benefits pension schemes is a good example of interventions which ended up shifting risks, actually shifting them to people who were much less able to bear them, and so greatly increased risks overall. But they reduced risks to the people who were paying judgment for the work. And so that is a very good test. If you shift risks but do not overall reduce them, you are behaving unethically.
I would like to ask one more question from the floor, but of course I agree with Louise about our need to apply a less quantitative approach, even though our profession has been anchored on quantitative analysis, and modeling as its core. But we adopted that to deal with a certain class of uncertainty which is resolvable and stationary. But we need to go into a world which require really very much a vision, skill set, mindset, domains, strategy of multidisciplinary thinking, systemic thinking, and narratives. And ultimately, it's also about culture and purpose, right? Hence, it's not just about the subject matter, but it's the context of the conversation and how we change the context. And it's a wicked problem, and we do it inch by inch, which I think they're doing. But now I want to go to Sam Accott's question. Sam Accott's question is a very meta question. I think you will enjoy his question. And his challenge is that we are in danger of thinking up solutions with the backdrop of utopia. Two general observations which pose problems for utopia. First, people prefer certainty over uncertainty. Second, people would like advantage for themselves in the form of money or security. If those two were core obstacles to achieving a better culture as a starting point for a better world, how could we resolve them practically? Who would like to have a go?
Well, certainly, John and I are pragmatists. We absolutely, one of the essences, basic principles of pragmatism is that there is no utopia. We're in a dynamic system which we cannot properly forecast. And so the myth of utopia is a very dangerous one. The myth of utopia is all bound up with the myth of certainty. It's just not an attainable objective. It's fundamentally denial of what human nature is about. Humanity is on a dynamic journey, a path to an unknown destination. And the very concept of utopia is a category mistake in recognizing what humanity is about. But now that John's back, let me pass. John, it's a criticism of utopia and certainty.
Yes, it's funny, I came across just the other day a quote from American conservative philosopher Robert Nozick, who said, can we imagine cavemen sitting around a fire discussing what their ideal society would be? And Nozick went on to say, what is it that makes us smile thinking about this picture that doesn't apply to us? And I think that was quite a thought-provoking observation.
I know Sam, and I'd like to respond to Sam as a protagonist rather than as a chairperson, because he basically brings up a problem of intersubjectivity, of how we bring our preferences to bear. And that's where psychology and personality types will give you a certain dimension. He said that many of us are motivated by money and security, but some of us are motivated by peace, by mastery over details, by power, by love, and by whatever, yeah, or by artistry, yeah. But actually, the question is to bring self-awareness into the whole thing about whether it is functional or dysfunctional, right? Because we can still have all those things, whether it is producing the sustainable outcomes we want. Hence, it is really a wicked problem, because we can't really attack this and say that this is the answer, and therefore get on with it. It's actually a very complex problem. We can only solve the problem in our little corner of ourselves, right? Essentially. So with that, I would like to pass to anybody else who wants to have a go at Sam's question. It's coming to the last 10 minutes of our session.
Well, I'll 2 minutes on that, because humans are, as I think I said in my lecture, humans are a very, very distinctive form of mammal. We can be dragged down to individual selfishness. We can be dragged in that direction if we're in a culture where the daily habits drag us in that direction. And that is the finance world that we've been living in the last few years. But we can equally be dragged up, because we are designed as humans, as a very unusual mammal, to be pro-social, to actually be willing to sacrifice our individual short-term interest for the longer-term interest of the group. That's why the tragedy of the commons usually doesn't happen. This is the Nobel laureate Elinor Ostrom, who showed that actually in real societies, the tragedy of the commons is a false parable of economics. It's just not empirically true. Why? Because humans have organized themselves into communities where the incentive of looking good in front of others, of being seen to be a good person by others, is much more powerful than short-term financial self-interest. That's the cultures we need to build. It's the cultures we've been tearing up by the roots the last 40 or 50 years. And we need to get back to putting them back together. So there is no intrinsic tension between the interest of society and individual preferences. There isn't. We've got trapped into cultures which create that tension. It's not inevitable.
Any last minute thoughts before I draw this to a close, because I got a program about the program in a whole year, which I need to update the audience. Any more last minute thoughts from anyone?
I suppose I could describe a kind of personal journey from spending the first 20 years of my career as a conventionally trained economist teaching the standard paradigms of economics, in which people go around maximizing things, in which people respond to incentives. And when I went out into a wider world, I came to realize that mostly people weren't maximizing anything. They were what people have called satisficing. They were trying to find courses of action that were good enough in the circumstances, in the uncertain circumstances in which they were operating. And secondly, and this comes to a point Paul made earlier, that it's not a better description of the way people behave than saying they respond to incentives. It's to say they behave in the ways you would expect them to behave in the environments in which they find themselves. Now, to some extent, it's true that the finance sector, for example, has attracted people who are naturally greedier, but it's also made them more greedy, because that's the kind of behavior which is expected and rewarded. Whereas the business in which my CEO 30 years ago had been trained and worked was one in which people understood that they were operating for a corporation that had a social role, which went well beyond simply making profits for shareholders. And that we need to understand that way of thinking about the world, and we need to restore a world in which people in business and finance think about it a great deal more than they currently do.
Excellent. Louise and Andy, you have any last minute thoughts? No.
Well, just picking up perhaps Paul's point about the power to reshape those social norms and our cultures lies within us. I think that's absolutely true. I think it does come from ideas, and that's why they are important and powerful. I think it does come from ideologies, if that's not too grand a word, but it also comes from a third eye, and the third eye is institutions. I think one of the great virtues and values of institutions is their long-lived nature. They don't bow to every near-term political whim, but also they have the capacity to change the narrative, to reshape that social norm for good or for ill, hopefully for good. Of course, I would say that working the 326-year-old institution myself, but it's not just true of old institutions. It's true of new ones as well. I think there is an important role the Institute can play in reshaping those social norms within your profession for just those reasons, Chieh.
Thank you. Louise, any quick remarks?
It is so important to remember that things change, people's attitudes change. One of my sidelines is early medieval history. Life was very different then. People's surface priorities were very different, but I suspect a lot of the same constraints operated, that you were part of that society, you thought how that society thought. That has changed. Society has changed. It's changed over the last 1,000 years, over the last 100 years, over the last 50 years. And it has changed through the people in it. So we have to remember that we're not stuck, that we can do things, we can help change things, hopefully for the better.
Wonderful. So I would just want to make a comment anchoring on the word utopia. There is no utopia on earth, but there are successful societies, successful cultures at a point in time. I think what we are observing, if you use the Hofstede, the anthropologist model, we have overswung to individual interest from collective interest. We have overswung to short-term instead of long-term. And we have overswung to low context culture from a high context culture. And that is a function of social norms and narratives. So from insurance products, we went up to the role of corporation. From a role of corporation, we go up to regulation and economic theories and societal norms and the adjustment to give us to a better world. So I think there are many layers of conversation. I want to thank all of you all for this. Whilst I go into my final slide as I close my this morning session. So thank you all for speaking to us today, and I would like to record my generosity, the generosity again of two of our sponsors, Dr. Patrick Poon and Milliman Consulting. Now I'm going to give you the concluding slide. This concludes our Finance in a Public Interest seminar. But but there are a number of upcoming events in the Thought Leaders program, which I would like to draw your attention to. And the first one I want to draw attention in no particular order. I will group them. Firstly, the actual innovation in COVID-19 era. This is a fortnight of events featuring internal and external speakers. External speakers include Chief Statistician to the government, Sir Ian Diamond, IFOA Honorary Fellow Sir David Spiegelhalter, who is also a leading statistician of his own right, and BBC more or less favorite actuary, Stuart MacDonald, amongst many actuaries. The fortnight series will also include a sessional meeting by the Biodiversity Working Group on the role of actuaries in biodiversity management. And on 18th of May, Professor Sir Adrian Smith, who is the President of the Royal Society and CEO of the Alan Turing Institute, will speak of mathematical futures, a theme which mirrors that of our IFOA's vision, skill set, mindsets strategy. The rest of the events have a decidedly system thinking, behavioral, and transformational bent on personal, organizational, and societal fronts. On the theme of systems thinking, Professor Keith Grint will speak on wicked problems next month, and Dr. Anthony Hodgson's on anticipatory systems and second order thinking on 5th of July, which really covers a lot of the issues we talk about because it is multifaceted, multi-level, and it's intersubjective, right? And the next group, which I will introduce, is leading educationalist and past chair of our lifelong learning board, Helen Wright, will speak to the growth mindset, which is the mindset we are encouraging in all actuaries. And Professor Hermania Ibarra of London Business School will talk about how we could transform our identities, working identities, as we navigate in the digital world. And the last one is by David Rook, who is a leadership guru, who will talk about the importance of operating beyond our skill sets by using a quotation from Frank Reddington: "The actuary who is only an actuary is not an actuary." And the series will culminate with a panel of past presidents, including Ronnie Bowie, Jane Curtis, Paul Thornton, and senior leader Sally Bridgeland, who will speak to the transformation of the profession at this important time in a question time format on 16th of July. And I know Louise will continue this series, this thought leadership program, into her presidential year in autumn on sustainability and the climate science series. As ever, I would encourage all of you to register. Each are free of charge, and more events will be added to the lineup in the coming weeks. So finally, I would like to ask all of you to provide us with feedback using the QR code, which we have put up 15 minutes ago, but we are so absorbed by the discussion so that we could make improvements in the future. So with this, I conclude with today's event, and we will send you the survey questionnaire by email. Thank you, and I bid you all a good day and a good weekend ahead. Bye-bye.